Greetings, members, one and all of the Salivation Nation. Gold price suppression. Does it exist? Well, let's explore. I'm going to be referencing an article here from the Gold Observer. And it's a piece, a very thoughtful piece, I thought, written by Jan Nieuwenhuis, that goes against popular opinion here in the precious metals community. You know, I do like to show contrarian points of view, although I do like to look at the also what is considered the norm in this community as well. I want to give everything a fair shake, and I also want to keep my mind open. And I believe the author of this piece wants to do the same, especially when you hear the very last sentence of this piece. So this is one that is quite interesting and very specific. Is the gold price suppressed on the COMEX futures exchange? He starts out by saying, after examining the roll data of gold futures contracts on the COMEX, I have found no evidence of gold price suppression. One of the most discussed topics in the gold space is long-term gold price suppression on the COMEX futures exchange in New York. It's an interesting theory because we know that in the past, the United States has been active in stabilizing the gold price to make the dollar look stronger. But that was done openly in the 1960s and 70s by selling physical gold. Is any entity still suppressing the gold price? And does it use the futures market? And he goes on to say here that price manipulation through spoofing, which can be small intraday price movements up or down, has been proven time and time again. And that's essentially also known as high-frequency trading, and that's commonly where it occurs, but not long-term suppression. And that is the distinction that I make and the argument that I make, and I believe that certainly there is manipulation. You've heard me talk about it multiple times on this channel, especially with regards to JP Morgan, which is probably the largest offender of it, and they are the biggest bank. Spoofing, price manipulation, which can occur on the way up and on the way down in order to profit from within establishments, financial institutions, and those that practice in that illegal activity typically do it to profit. They don't care where the price is as long as they make money in manipulating the price one direction or the other. In a recent video, precious metals commentator Andrew Maguire was talking about gold price suppression and mentioned that traders can roll large futures positions towards the regulator. He stated, "You mean you can roll it over and ad infinitum? If there's one thing you should focus on, it is that. Gold futures can indeed be rolled ad infinitum, just like corn, sugar, stock, indices, bonds, FX, and crypto futures. Rolling is an essential feature of the futures market. Though Maguire brings up an excellent point for investigating if a massive short position in the gold futures market is suppressing the price, the roll data." So we're going to get into some of the nuance, and a lot of this stuff is fairly complex, and I believe some of the weeds of this and some of the details and the complexities of this can lead people to believe one thing or the other, and that is the problem with really coming out with a clear and concise case for or against suppression. Futures can be traded many months into the future. For gold, February, April, June, August, October, and December are actively traded months. The rest can be ignored. The near month always captures the bulk of trading volume and open interest. At the time of writing, the most actively traded contract on the COMEX is February. So right now, we are in December right now, so we can see that. So if we run through a scenario of long-term price suppression on the COMEX to subsequently examine roll data and see if it's actually happening. Suppose that a crooked entity sells short hundreds of thousands of contracts. This is very difficult because the regulator sets position limits for all traders, but we'll assume the crooked entity has found a way to circumvent the restrictions. The massive short is opened in the near month, driving down the futures price, and through arbitrageurs, the futures price is translated to the spot market. The price of physical gold is suppressed too. Any future position will eventually expire. The massive short seller has three options. The first possibly is to close the short position by opening an opposite position. In case of a massive short position, an equal amount of contracts will have to be bought for the clearinghouse to net it all out. The result will be that the initial price suppression of the massive short would be undone. Closing a short leads to the price going up. The second possibility for the massive short is to physically deliver the metal. From COMEX delivery data, however, we know only a small percentage of the open interest is physically delivered. Yeah, we definitely know that a lot of those markets are not tested. No big short is delivering hundreds to thousands of tons of gold every other month. The third possibility for the massive short is to roll by closing its near month position to open a new massive short in the next active month. But a large roll would leave traces in future prices. When a massive short is rolled, the price of the expiring month is pushed up, and the price of the next active month is pushed down. The spread between the contracts calculated as the next active month minus the near month would decline during the roll period. What I did, or what Jan did, is grab the settlement prices of the COMEX website and made a chart. And there's a progression of the spread that he did from December 2021's and the February 2022 contract from the beginning of October to the end of November. The last day of November was the start of the delivery procedure for December, so most traders rolled or closed their December positions prior to that. And this chart kind of shows that, and everything's kind of going up there. But it's a jigsaw pattern here for the February minus December spread. I'll actually post a link to this article in the description below so you can see these charts. But I figured you'd probably want to take a look at some gold, physical gold instead. Holding that physical gold is something that I believe, no matter what your views are on manipulation, is something to behold by holding gold for multiple different reasons. More on that momentarily. Clearly, the spread increase leading up to the end of November signaled the longs were more eager to roll than the shorts. In other words, it looks like more longs than shorts rolled. So, in conclusion, if there was any period suited for holding down the price of gold, it was in the past few months when the world was shocked by the highest inflation numbers in now 40 years. In the data, there is no evidence of a massive short suppressing the gold price on the COMEX. The only critique of his methodology that he admits is that he used settlement prices instead of bid and ask quotes, and he doesn't have the resources to obtain the latter. Supporting his findings is a similar investigation performed by Keith Weiner from Monetary Metals, who used spot and futures bid and ask quotes over several decades. His conclusion is the same as mine, and that's Monetary Metals, which I think is a dealer. So yes, indeed, he talks about this too, and in a disagreement with Ted Butler, who is pro manipulation or pro suppression, and we'll reference that here momentarily. And his conclusion that there's no evidence of gold price suppression of the COMEX. So the last sentence of this article, it's quite telling. Having said that, Jan would be happy to change his mind if anybody has new evidence. And so there you go. I think that's good to be open-minded to it, for sure. And there is a this agreement, again, that was posted here. And it's a pretty long writing. You can see it linked into this article below. But I think this talks about, I believe, silver. And I may actually talk about that maybe in a separate video referencing this piece. But we'll keep this one on gold and specifically on the COMEX here in this. But, a lot of this stuff is because the Commitment of Traders report is pretty vague in some of its findings. And there's only so much that's shared there. People can infer a lot from some of these reports and some of the things that come out there. But what is it about holding the physical gold in itself in this form that kind of protects you from all manipulative forces? And that is that you are holding the metal, you pay a premium, and essentially you are paying to hold it. That premium can be a pretty big deal, but it's less of a deal for gold than it is for silver because the premiums are much smaller. I mean, and really it makes sense because you think about it. To mint a coin like this takes exactly the same energy once the metal was refined as it would a silver coin. So the spread is much narrower, and so therefore, when you buy this coin, you're paying in a sense that part of that premium is for production cost, and there's only a slight premium based percentage-wise, whether it be from anywhere between 5, 6, 7, 8% for gold per ounce, as opposed to 11, 12, 14, up to 50% for silver, and depending on the type of coin it is. And so when you take into account all of that, it gives you a little bit of a perspective, and you're essentially holding much less risk, especially if you buy it at a lower price. However, you're not going to see gold at a much lower price than it is now, even in recent dips that we've seen here in the marketplace lately. And some can blame that on manipulation. Well, if the manipulators are really trying to suppress the price of gold, they're doing us a favor. They're doing us a huge favor when we buy this stuff and we hold it, because we know that in the long course of time, it's going to be a stable store of wealth. Stable store of wealth. That is really what is the selling point for gold. It sells itself because it has been that for millennia. We live in a time, especially in these last few years, where we have seen the markets upside down. And the timing of gold's price is not in concert and coincidental with the activity that we're seeing in the economy. Inflation, geopolitical tensions, the coronavirus pandemic, uncertainty with all kinds of different things, but mainly inflation. And what is that going to look like a year from now? What's going on here? Well, in the past, we've seen uncertainty too, and we've seen low gold prices compared to where they should be with inflation happening. This is not new, but in some ways it is a little different this time around in terms of market activity. And so therefore, we're getting it at a discount at this point, even though it really is high compared to pre-pandemic levels, much higher compared to pre-pandemic levels than silver was. Silver is higher than it was during the pre-pandemic. However, silver's price has fallen dramatically, and the ratio between gold and silver has risen dramatically since the pandemic. And that is something that I think is something to behold here. And so therefore, you holding that physical gold, and that's what I mean, holding it, not selling it, you are protected unless you absolutely have to sell. And and I'm hoping that you won't have to sell because you have enough of these in reserve, these Federal Reserve notes in reserve, your own personal reserves. And yes, I'm even talking about outside of the banking system. But I'm not totally against you having some in the banking system. But if you can find a way to safely store cash on site, that's a good thing. In fact, I have a golden envelope challenge that I did where I put some cash in an envelope, And of course, if there was a fire, well, all that's gone. So you have to put it in a fire-protected safe. And I should have mentioned that's where it's held, in your home and that type of thing. And it's good to have that kind of stability. Or if you don't have one, in fact, some of that stuff and gold I keep in a separate location. The thing is to have some cash outside of the financial institutions, just in case. But there you have it. Let me know what your thoughts are. A very interesting article, kind of complex in terms of some of the information in it, but I believe that when you take a look at the rationale and the studying what happens with some of that data, you can derive a reasonable conclusion thereof. And it looks like that Jan has done this, Mr. Newenhouse. So there you go. Let me know what your thoughts are in the comment section below. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.